Bitcoin and Ether are holding steady, shrugging off the 25 basis point rate hike by the Federal Reserve. Joining us now to discuss the crypto markets is Morgan Creek Capital CEO and CIO Mark Yusko. Welcome to the show, Mark.
Good morning. Good to be with you.
Good morning. Good morning. All right. We are going to talk about this rate hike that everyone was expecting. The Federal Open Market Committee raised its benchmark Fed funds by 25 basis points. The European Central Bank also just announced a rate increase. What's your reaction?
I think it was mostly a non-event. You've seen that in the market reaction. It had been priced in the market for weeks. And, I think the thing that people really are paying more attention to, or should be paying more attention to, is the fact that despite the rhetoric on higher short-term rates, they are still expanding the money supply. So M2 has turned back up really since the bailout of SVB. And I think that's why you've seen things like Bitcoin and other cryptocurrencies do so well. Because remember, we don't price Bitcoin in Bitcoin. We price Bitcoin in dollars or yen or euros. And those currencies are all continuing to weaken.
I want to talk about that increase in liquidity in just a minute, but the next meeting is 8 weeks away in September. What's the likelihood we see another rate hike there? And do you think the market is going to react?
Yeah, look, I think the chairman was very clear. No more hikes this year. So I think we're done with the Fed funds rate. The funny thing about the Fed funds rate, I don't know about you, but I don't borrow at Fed funds. No one I know borrows at Fed funds. It's really a rate that is used for interbank transfers and loans. And a higher Fed funds rate allows the banks to have higher spreads, higher net interest margins. And it's good for bank profits. So I think that part of the market may cool down a little bit after having a nice run here lately, if there's not going to be any more increases in Fed funds. But overall, I don't think the market's looking at interest rates going forward. I think now everybody's focused on, he said there's going to be no recession. So now we can take the boogeyman off our back and focus on all this growth. Well, what growth? I mean, I don't see a lot of growth. I don't see any inflation. And inflation was a big part of that growth, in that prices were rising. So people put up higher sales numbers, but then they had higher costs, so the profits weren't going up as much. And look, I think the big thing for me is the earnings game that gets played. You just had a guest on talking about the Meta beat. Look, if you told me a year ago you were going to make $1, you told me 6 months ago you were going to make 50 cents, you told me last week you were going to make 10 cents, and then you make 11 cents, that's not a beat. Right? I mean, okay, technically it's a beat and it goes in the books as a beat. But to me, that's like, being the high jump guy, and you go up and you take the bar off the rack, you put it on the ground, you jump over it, and you call yourself the world champ.
Step over it. Yeah. There's not even any jumping involved there.
No jumping.
Well, you mentioned the increasing liquidity. I want you to unpack that a little bit more for us. You've said that the Fed and other global central banks are quietly increasing liquidity. Tell us more.
Yeah, so it started with China back in October. And, once again, China leads the way, as they are prone to do, in liquidity. They are the kings and queens of producing liquidity. You go back to 2017 and everybody said, the Fed bailed us out and Bernanke was this hero. No, it was China. They printed $4 trillion with a T dollars. And starting in October, they created about $1 trillion worth of liquidity. The U.S. was still in QT, quantitative tightening. Europe was still in tightening. And what's interesting, I haven't heard the word quantitative tightening in months. And nobody's talking about contraction of the money supply because it's not contracting. It's actually rising. And when you have a rising money supply, you get a weaker currency, and then you get an increase in the price of things that are priced in that currency, like gold, like Bitcoin and the like. So I think quietly they talk this rhetoric of, hey, we're still hawkish and we're still focused on inflation. Show me the inflation, right? We're at 3%, probably heading to sub 2. Chairman said it's not going sub 2. I'll take the under. The one funny thing about the Fed, and not the chairman, but the Fed is an organization. They have hundreds and hundreds of PhDs, and they forecast inflation and GDP every quarter. And they've been right 0 times. Out of almost 300 estimates, they've never been right. I could flip a coin and be right half the time. So I just think it's interesting. So there's either some gamesmanship in that they intentionally try to be wrong to, create an illusion of beat, right? That's they take the bar off and put it on the ground thing, or some other reason. But I'm not privy to that.
I want to change gears and talk about Bitcoin here. You recently predicted that the price of Bitcoin could reach a market cap equivalent to gold. That was on the Wolf of All Streets podcast. This would translate to a price of $300,000 for one Bitcoin. Unpack that for us. That is a big prediction, but when I heard you unpack it on the podcast, it made sense to me.
Yeah, and it's not an overnight prediction. It's not tomorrow. It goes like this, right? So gold is the only money in the world. And what is money? Money is an asset that exists in the absence of a liability. Now everybody says, well, what about all this other stuff? These dollars or yen or euros. We use them as money. Well, no, we use them as currency. And they're created by banks, central banks, and they're backed by debt. So it's not that they're bad or evil. It's just they're not money. Money is an asset that exists in the absence of a liability. And so for 5,000 years, it's a long time, gold has played that role. And we had experiments with other things along the way, puka shells and stone wheels and things like that. But gold has survived through belief and custom. And 1 ounce of gold for 5,000 years has bought a fine person's suit. So from Cleopatra's time to a suit of armor to a zoot suit in the 20s to Savile Row today, you or I could go to Savile Row and for a single ounce of gold, about $1,900, we could get a fine suit. And that's about what it would take. So what's changed? Well, gold suffers from 2 things. It's not very portable, meaning it's really heavy and clunky, and it's not very divisible. Like if I had a bar of gold here and go pull it out of the safe and I wanted to give you half, right? Because it's been a nice interview. I wanted to give you half. Even if I could break it in half, which I couldn't do, I'd have a hard time stuffing it in the computer and sending it to you. So it's not very divisible. I can't break it in half, and it's not very portable. I can't send it to you. Well, Bitcoin fixes both of those. It is equally scarce. Its stock to flow ratio is the same as gold. The amount that's lost or stolen every year roughly equals the amount that's created. And so it's a scarce asset. Well, why do scarce assets matter? Well, a scarce asset, which also exists in the absence of a liability, it wasn't created by a government with debt, has an interesting feature of being a perfect store of value. So as people realize that in the digital age, and Bitcoin being more divisible and more portable, I can punch a few buttons on my smartphone and send you Bitcoin immediately. You don't have to have a bank account. I don't need to have a bank account. We can make that transfer of wealth instantaneously. So the monetary value of gold, to sum up, is about $6 trillion, give or take. The total value of gold is about 11, but 5-ish of that is jewelry and chalices, and that doesn't really count. But the monetary that's in central banks around the world is about 6 trillion. I think Bitcoin can replace all of that. The monetary equivalent, 6 trillion, is about a 10x from here. So it gives us a price of about 300K.
All right. Well, when you talk us on that journey, like I said, the pieces start to come together really quickly before we wrap here. How long before you think we reach that 300K, or how long before we reach this future that you've just explained? So
look, I've said for years, so that was like a 10-year process, and we're probably 3-4 years into that. So I can still, I would say the next halving, not this halving in 2024, but the 2028. And where do I get that? Well, every halving, we've added a zero. we've about 10 times the market cap of Bitcoin. So we went from 100 to 1,000, 1,000 to 10,000. I think this halving next April, we go to 100,000 as fair value. But in these movements during crypto fall, right? We're in crypto summer today until next June. Then after the halving, we go to crypto fall. That's the parabolic, everybody's crazed and FOMO rules. We usually go above fair value. So I think we could get into the high hundreds, maybe even a couple hundred, but let's call it the high hundreds, 150, 180. And then we go into the next crypto winter. So we have our correction. Then for the next halving in 2028, the fair value jumps to $1 million. And people say, $1 million, that could never happen. Well, hopefully by that time, we're not talking about Bitcoin, we're talking about Satoshis. Because the Satoshi is the unit of measure that we should all, I think, be talking about, which is there are 100 million Satoshis per Bitcoin. And then we don't have to think about, well, Bitcoin's $1 million. No, a single Satoshi is worth fractions of pennies at some point.
All right, Mark, we got to leave it there. Thanks so much for joining the show this morning.
Thanks for having me. Talk to you again soon.
That was Morgan Creek Capital CEO and CIO Mark Yusko.